Welcome to the Deep Dive, where we take your stack of information and distill it into knowledge you can immediately put to work. Today, we are wading into a bit of a tangle in the markets. It's this alphabet soup that has caused some serious confusion.
Oh, yeah.
And it's confusion that can really cost investors if they're not careful. We're talking about the tickers, XRP and XPR.
And it is so much more than just a couple of confusing names. What you have here are two fundamentally divergent blueprints for the future of how value gets moved around.
Right.
So our mission today is really to strategically dissect the protocols behind them. You've got the XRP Ledger on one side, all about institutional settlement.
And then the Proton Network, using the XPR token.
Which has this completely different consumer-first approach. It's a fascinating contrast.
Okay, let's unpack that right away. Because that difference, the target market, it seems like that's the key to understanding everything else.
It absolutely is.
So on one hand, you have XRP, which is, driven by Ripple. This is the established player, the institutional settlement layer. They're going after global high-value wholesale banking.
And on the other side, you've got XPR, the newcomer, really aiming to win over the everyday user. They're the disruptors focusing on this feeless payment model.
Which is a huge hook.
A huge hook. It's all about ease of use, human-readable addresses, and integrated identity. They're trying to solve completely different problems for completely different people. Okay,
so let's start with the big one then. XRP Ledger's institutional mandate. When we look at the source material, its utility seems crystal clear. It's designed to be a dedicated bridge currency for something they call on-demand liquidity, or ODL.
Yeah.
And this is all for cross-border finance.
That is the core mission. Their market is explicitly the interbank and payment sector. The goal is just raw efficiency, getting around those slow, expensive legacy systems.
Like Swift.
It's exactly like Swift. But, even more important than the speed is reducing the capital that banks have to have tied up in these old methods.
And that leads us right into some of that complex banking jargon we saw. Minimizing reliance on pre-funded Nostro and Vostro accounts.
Yeah.
For anyone listening who isn't a banking specialist, what exactly are those and why is getting rid of them such a huge selling point for an institution?
That's a critical question. So think of Nostro and Vostro accounts as locked up piles of cash.
Okay.
If a bank in New York wants to send money to a bank in Singapore, they first have to fund a Vostro account over in Singapore with the local currency.
So the money's just sitting there.
It's just sitting there, idle, sometimes for days or even weeks. And that capital is costing the bank money through opportunity cost and exchange rate risk.
Right.
XRP's ODL system uses the token for instant settlement. So those banks can just release all that trapped capital. It's about tackling that high-value infrastructure friction.
Okay, that makes perfect sense. Now let's do a complete 180 and pivot to the Proton Network and XPR.
Totally different world.
Their core utility is designed for the mass consumer, a layer 1 public blockchain for everyday apps and peer-to-peer payments.
And the whole architecture, it just has to be different because their big selling point is all about usability and compliance. But for the average person,
right,
the network is built around this secure, decentralized identity layer that's set up to handle KYC for individuals.
Know your customer.
And KYB, know your business for companies. It's this big effort to build a compliant bridge directly into traditional consumer finance.
And the most impressive usability feature, the thing that I think lowers the barrier to entry so much, is getting rid of those long, impossible to read wallet addresses.
The alphanumeric strings, yeah. We've all been there.
Oh, absolutely. Double checking a 40-character address, just praying you didn't miss one digit before you hit send. XPR uses human-readable names, like @JimmyJammer. That fixes a huge psychological hurdle for adoption.
It really does. And, this difference in mission is also reflected in their age. It's worth remembering the XPR network launched much later, back in May 2020.
Okay.
And it got its foundation from a fork of EOCO. XRP has, almost a decade-long head start in building those institutional relationships. And that fundamentally shapes the path they're on.
Let's dive into that path then. The technology that underpins XRP's whole strategy of courting these highly regulated institutions. We keep saying speed and resilience, and that all comes down to their consensus mechanism, which, as you said, is not proof of work.
No.
Or even a standard proof of stake.
That's right. The XRP Ledger uses this unique protocol. It relies on a network of validator nodes, but here's the key part. Each node keeps what's called a unique node list, or UNL.
The UNL.
Yeah, and it's a curated, limited set of trusted servers. And these are often run by reputable organizations, payment providers, or even the financial institutions themselves. It's a very deliberate system.
And the payoff for making that choice is just raw performance.
That is the main advantage. Performance is everything to their mission. This system gives you incredibly fast transaction finality. We're talking 3 to 5 seconds.
Yeah.
It's built for scale, about 1,500 transactions per second, all with, fees that are fractions of a cent, and it's super energy efficient, no mining.
But there's always a but. This institutional grade performance, this guaranteed speed, it comes with a trade-off that the sources were pretty clear about.
It absolutely does. The UNL model gives you the performance and resilience that are, frankly, non-negotiable for a bank.
Yeah.
But you do compromise on what we call the standard definition of maximal decentralization.
We saw one security review that really highlighted this. It gave the XRP Ledger a lower score, 41 out of 100, because of a low Nakamoto coefficient.
Right.
For our listeners who aren't, tracking decentralization metrics every day, what does a low Nakamoto coefficient actually mean? And why would a bank be okay with a score of 41 out of 100?
It's a great question. It means that a relatively small number of participants, in this case, the validators on that unique node list, would need to work together or collude to either stop the network or censor transactions.
So fewer parties are needed to take control.
Exactly. But institutions accept this compromise because they are trading that maximal anonymous decentralization for guaranteed, predictable performance.
And I assume regulatory comfort.
And the regulatory comfort that comes from knowing exactly who the reputable players are in that validator set. For a bank, a reliable 3-second settlement is just more valuable than having a validator set of 10,000 anonymous people.
That sets up the whole compliance conversation perfectly. Ripple is clearly making these huge moves to align with regulated finance. The launch of Ripple USD, or RLUSD, seems like a massive step.
RLUSD is, I would argue, the most important development for them outside of ODL. It's their own USD-denominated stablecoin.
And the credibility comes from who's issuing it.
That's the key. It's issued by their regulated subsidiary, Standard Custody and Trust Company, which is supervised by the NYDFS. That is a very high bar, and it's fully backed one-to-one by cash and equivalents.
And they're not just launching it in a vacuum, they're building the roads for people to actually use it. We saw that big partnership with Alchemy Pay.
Yeah, that's for fiat on-ramps.
Right, in over 173 countries. That just drastically lowers the barrier to entry for institutions and global users who want to get their hands on this regulated product.
And you can already see the adoption happening. Ripple's tech has been adopted by Amina Bank, which is the first European bank operating under Switzerland's FINMA supervision.
That's a huge stamp of approval.
It's a massive regulatory benchmark for the whole ecosystem. It basically tells other banks, hey, our peers are using this, it's safe.
But even with this heavy institutional focus, XRP can't just ignore where all the volume is happening right now, which is in DeFi.
No, they can't.
And that's where wrapped XOP, or WXRP, comes in.
WXRP is absolutely essential for them to extend their utility and liquidity beyond their own ledger. It's an ERC20 token, it's one-to-one backed, and it's deployed by a regulated custodian, Hex Trust.
And the whole point is just to get XRP on other chains.
Exactly, to let XRP liquidity flow onto those high-volume chains that have really deep DeFi ecosystems, so primarily Ethereum and Solana.
And the numbers we saw really show why they have to do this. I mean, if you look at Solana's 24-hour decentralized exchange volume, it's something like $3.9 billion.
That volume it's just staggering. It is approximately 575 times higher than the XRP Ledger's own native DX volume.
575 times.
Which sits around, what, $6 or $7 million? That massive difference means the deep liquidity that institutions need, it just isn't there natively on the XRPL yet.
So it's not a choice, it's a necessity.
It is a strategic necessity. If Ripple wants XRP to play in those global deep DeFi liquidity pools, they have to export it using a regulated vehicle like WXRP.
Okay, let's shift gears completely again. Back to XPR and the Proton Network. Their architecture is tailored for the consumer, right? Using Delegated Proof-of-Stake.
Yep, DPoS, built for high throughput, designed for scalability. They cite up to 4,000 transactions per second.
But the real hook, the key differentiator for the user, is that it's feeless.
The absolute feeless transaction, end users pay zero, nothing.
That sounds too good to be true. If the user pays zero, who pays for it? Who bears that cost? And is that model even sustainable in the long run?
That is the billion-dollar question. The resources are subsidized,
Yeah.
usually by the dApp developers building on the network or by the block producers themselves.
How does that work?
It's an innovative resource model designed to get mass adoption. The XPR tokens are critical. You stake them for governance rights to vote for block producers, and then you get rewards.
Okay.
And those rewards are drawn from a 1.5% slice of the annual inflation rate. So it basically turns the users into subsidized participants in the network's security and governance.
And the identity piece is also a crucial part of this for both compliance and just making it easy to use.
Absolutely. The network uses the Proton Verified Identity System to link real identities and real fiat accounts directly to the blockchain.
So that's how they get money in and out.
That's how they enable real-time fund processing and build credibility. I mean, if you're going to onboard millions of consumers, you need a super smooth, compliant bridge to traditional banking. Identity is the bottleneck they're trying to solve.
Which brings us to a major structural risk that the sources pointed out, the economic sustainability of the XPR token itself, the tokenomics.
And this is maybe the single most critical difference between the two. The XPR token has no maximum supply.
No max supply.
None. That makes the asset inherently inflationary. Right now, it's set at a 5% annual rate, which gets distributed across the whole ecosystem, block producers, stakers, the steering committee.
So, if the asset is fundamentally designed to inflate, the challenge is enormous. For the value of XPR to hold up, demand from new adoption has to consistently and perpetually overcome that 5% inflation every year.
That's it, exactly. The long-term viability of this whole feeless model hangs on whether verifiable institutional or developer adoption comes in to fund the resource model and drive that consumer critical mass. You need to see significant demand coming in to soak up that new supply.
And the current metrics, they suggest that demand isn't quite there yet.
The data we saw shows some pretty acute liquidity constraints. Market turnover rates are low, hovering around 2.2 to 2.6%.
Which isn't a lot.
No. It suggests that the current demand and liquidity just aren't enough to reliably counterbalance that inflationary risk. The risk-reward profile here is just inherently higher than for a mature, finite supply asset.
Given all of that, this branding battle becomes so important. The comparison is unavoidable just because of these systemic market confusion. The names just sound and look so similar.
And this is a very real risk, especially for retail investors who might confuse the two. There's been some, I think, justifiable criticism that XPR, the Proton token, is leveraging the brand recognition of the decade-old XRP.
To attract misinformed investors?
Yeah, people looking for the next big thing.
We've even seen analysts making these direct comparisons, saying that buying XPR now is like getting into XRP back in 2015 or 2016.
And that kind of narrative is so dangerous because it encourages hype to overshadow the really fundamental differences in tokenomics and market strategy we've just been talking about.
That hype is especially dangerous when you look at the liquidity profiles.
Totally different. XRP has deep, robust liquidity on major global exchanges. Institutions can move huge amounts of capital without really moving the price.
Whereas XPR
suffers from acute liquidity constraints, just like its low turnover suggests.
And we saw a perfect example of how quickly that liquidity risk can just blow up into volatility. When the KuCoin exchange delisted XPR for margin trading, the fallout was immediate. The price dropped, 4.76% in 24 hours?
And in a thin, illiquid market, bad news gets amplified. It hits the very consumers that XPR is trying to attract the hardest.
It's important to note, though, that they're not completely separate worlds. The networks can technically connect.
Right. It's not a zero-sum game, technically. The sources did confirm there's a dedicated XPR bridge account set up on the XRP Ledger.
Okay.
And the two assets, XPR and XRP, they're actively traded as a direct pair on exchanges. So there is technical interoperability and at least some market demand there.
So when we bring it all back to the big picture for you, the listener, what does this all mean? You've got two assets, confusingly similar names, but just radically different blueprints.
At its core, XRP is the mature, regulated business-to-business utility.
Yeah.
It's ruthlessly focused on liquidity, speed, and enterprise compliance.
And they're willing to make those trade-offs on decentralization metrics.
To get the guaranteed performance that a financial institution absolutely demands.
And then there's XPR, the high-risk, high-reward business-to-consumer technology. It's betting everything on usability, on identity, on those feeless payments.
But it's facing these substantial systemic economic risks from its inflationary design and its current low liquidity.
So the key takeaway for you, as you're trying to make sense of this, is pretty simple.
I think so. XRP's success, it really hinges on enterprise adoption and regulation. It needs more partnerships with supervised entities like Amina Bank and the whole NYDFS supervised RLUSD project.
While XPR's success hinges entirely on achieving genuine consumer critical mass.
Yeah, and that adoption demand has to be big enough to consistently and perpetually overcome its built-in inflationary design.
So we've seen that the XRP Ledger, it prioritizes performance for institutions by compromising on those maximal decentralization metrics like the low Nakamoto coefficient.
And on the other hand, the XPR network prioritizes consumer adoption by compromising on deflationary tokenomics, relying instead on that infinite supply.
Which raises this really important kind of overarching question for the future in digital finance.
Which foundational compromise will ultimately prove more sustainable? Is it performance over pure decentralization, or is it feeless transfers over scarcity?
That is something for you to think about as you continue your deep dive. Thank you for joining us.
We'll see you next time.